The usual disclaimer applies. The views expressed here are our views and not necessarily the Bank of England's view. In this paper, we examine the role of flood risk and increases in flood events for the UK housing and mortgage market. We exploit both the geographic and time variation of flood risk and flood events in the UK, making use of a panel of mortgages and house price transactions. We observe that house prices decrease following long flood events. By contrast, lenders don't take this into account when adjusting the valuations of houses for the mortgages, nor specifying the mortgage contracts in terms of mortgage rates and loan amounts. We take this as evidence that lenders do not closely track the risk of extreme weather. It has been claimed that climate change increases the frequency and severity of extreme weather events such as flooding, and this impacts homeowners and properties. At the same time, there's evidence that risks of flooding and rising sea levels might have adverse effects on property prices. It's been known that housing collateral is relevant for households when making their housing consumption and borrowing decisions, but much less is known to what extent financial institutions and lenders in particular take into account the risks of these extreme weather events. And this is where the focus of this paper is. In this paper, we examine something we call the valuation channel of flooding or of extreme weather events. In particular, we ask whether flooding and the risk of flooding affects house prices. So we revisit the existing literature, and then we go beyond and ask whether lenders do take the decreases in house prices into account when making their appraisals and when specifying the mortgage contracts in terms of the credit premium they ask and the loan amounts they give. This analysis contributes to two broader strands of the literature. On the one side, the literature on house valuations. It has been shown during the financial crisis, banks over-evaluated properties. And then secondly, to a general class of the literature examining the role of extreme weather events for credit markets. In this paper, we examine two specific events. On the one side, we look at the 2013-14 winter flood, which occurred in the UK, and we compare the effects to a parallel review of flood risk maps by the Environment Agencies, which was publicly available. Our empirical strategy is essentially a repeated sales or repeated borrowing approach in which we basically follow properties over time and mortgage borrowers over time. This allows us to control for unobserved, time-invariant property and mortgage characteristics, and it allows to sort of hold loan demand constant and focus on loan supply by exploiting a characteristic of the UK mortgage markets, namely the monetary incentive to remortgage after 2 or 3 years on average. Our analysis is basically a local neighborhood comparison. This allows us to hold local economic conditions constant, which might change following flood events. And we address self-selection of households into these high flood risk areas by doing a matching exercise, which I explain in detail in a bit. In terms of results, we find a preliminary, more descriptive results that there's evidence for self-selection. So there's high-income, high-wealth households self-selecting themselves into these high flood risk areas that are exposed flooded. And secondly, and most importantly, we find this decrease in the sales price of properties following long floods of at least 50 days. However, we don't find evidence that lenders take these decreases in property prices into account when making their appraisals, nor they adjust the interest rate they charge on these mortgages or adjust the loan amount. We believe that the results come with two policy implications. On the one side, there's evidence that lenders do not closely track the impact of extreme weather, flood risk in this case. This might be a justification for automated valuation models, which automatically track house prices at a local level, and it might be a case or justification for climate stress testing. The more descriptive results of how high-income borrowers self-selecting themselves in these high-risk areas could question the justification of subsidized flood insurance, which is, for example, in place in the United Kingdom. As I say, we look at the 2013-14 winter floods. They occurred between November 2013 and February 2014. They consisted of both groundwater and coastal floods. The damages were about 1.3 billion on average, which is slightly above the 99th percentile of natural disaster in the United States, but slightly below the 2007 flood we had in the United Kingdom. And it affected two major regions, the River Thames catchment and the east coast of England. We compare this to an update of flood risk maps by the Environment Agency, which gives us a large number of increases in the estimated flood risk. And as a side mark, properties in the United Kingdom are typically insured at mortgage originations, and the statement of principle, which was in place until April 2016, ensured the availability of these flood insurances. So what we do is we do basically a before-after diff comparison. So we look at the three-year window before the flood event. We take out the flood event itself, November 2013 to February 2014, and then we compare the pre-window to the post-window of also 3 years. In terms of data, we use publicly available information on flood events. It includes the source, rivers, seawater, or others. It excludes the exact date of the flood event, which allows us to calculate the duration of the flood in the number of days. It gives a measure of the flood outline in square kilometers, and we use these flood maps at the 6-digit postcode level. Very briefly, we complement the flood outlines with the ex-ante risk, also from the Environment Agency, also on the 6-digit postcode level, and information on the population of all property transactions in the United Kingdom, which gives us the sample of the repeated sales panel, and the population of all mortgage transactions in the United Kingdom, which gives us the sample of the repeated mortgage transactions panel. As I say, in our empirical analysis, we make use of both the time variation and the geographic variation. To illustrate this, please have a look at this graph. It kind of shows, it exemplifies a region that is potentially flooded. In this case, it's a postcode region. There's water, there are houses, and some of these houses are treated. So these are the houses that are either flooded or experience an increase in flood risk. So these are the houses that we are ultimately interested in. And what we do is basically a local comparison. So we look at properties that are flooded and compare them to properties that are close by but not flooded. Now, these flooded properties, they might be different. They might be different in terms of their price. They might be different in terms of their distance to the water. That's why we do a matching exercise to ensure that we only compare properties and borrowers that are very similar. And this is ultimately the matched sample that we look at. We use this matched sample and run basically the following regressions. Our outcome variable is basically the change in the property price or the change in the property valuation over time in the 3-year window before and the 3-year window after. And we relate this to indicators of a flood event happening. At least 50 days is the flood event long. Up to 50 days is a short flood event, an indicator of whether the property or mortgage borrower experienced an increase in the estimated risk, and most importantly, a fixed effects, the postcode district fixed effects, which ensures that we actually compare properties in a local unit. In terms of results, we do find descriptive evidence of self-selections. So this graph shows kind of characteristics of properties and borrowers by 4 different groups. Properties that are flooded ex post, long flood, column 1, short flood, column 2, increases in flood risk, column 4, and column 3. And column 4 shows properties and mortgage borrowers that are neither flooded nor experience an increase in flood risk. And it's interesting to see that exposed flooded properties, the first column, are on average more expensive, £350,000, than properties that are neither flooded nor experience an increase in flood risk, £210,000. Mortgage borrowers in these properties have higher income, the exposed valuation is higher, the loan amount is higher, and the LTV ratio, the loan-to-value ratio, which is an important dimension for credit risk of mortgages, is lower. So why is this the case? We believe it's related to the distance to the water. So the distance to the water of exposed flooded properties is shorter, which is not surprising because it implies higher flood risk. So we believe that distance to the water is correlated with flood risk and some sort of unobservables. It could be amenity values, sort of the utility that people get from living close to the water, the view, for example, or employment opportunities. And this is we believe that's an interesting result in itself. However, there's this concern for our main analysis that trends in property prices across our treatment and control groups are different, which could confound our analysis, our difference approach, which relies, technically speaking, on a parallel trends assumption. So that is why we do this propensity matching approach, where we basically look for every property that is exposed flooded and every property that experience a flood risk. We look for properties and mortgage borrowers that are very similar in terms of their property price and in terms of their distance to the water. And then we look at the matched sample of just the subset of these properties and borrowers. And this is the sample that we use for our ultimate analysis. We run basically two different analyses. On the one side, we look at the risk increase, and on the other side, we look at the effects of flood events. In this case, the dependent variable is the property price, the change of the property price. We observe that an increase in flood risk is uncorrelated with property prices. However, we observe that following long floods, house prices decline by about 4 percentage points, which is in line with the existing literature. When we look at the sample of mortgage borrowers, now we look at the mortgage valuation done by the lender, however, we observe that lenders don't adjust, we don't observe evidence that lender adjusts their valuations. In this case, flood long comes in statistically insignificant. In addition to the valuation of these properties, we also look at the mortgage rate the lender asked and the loan amount. And in both cases, the mortgage rate shown in column 1, there's a statistically insignificant coefficient, and the loan amount comes out statistically insignificant. So overall, we take this as evidence that lenders do not mark to market after prolonged flood events. So valuations are biased upwards, and lenders do not seem to offset this valuation bias by adjusting the loan rates nor the loan amounts. Somewhat surprisingly, increases in flood risk do not affect house prices and neither property valuations. And then thirdly, the descriptive result that I showed at the beginning, there's evidence for self-selection, so there's high income, high wealth households in these exposed flooded areas. In terms of next steps, something interesting to look at would be sort of expanding the sample over time, looking at whether the effects change once we kind of look at more recent flood events, look at across neighborhoods. So this analysis is a local geographic comparison. It would be interesting to see whether the effects change once we kind of disaggregate and look at more at higher level of aggregations. And it would be potentially interesting to look at the heterogeneity of regional versus national lenders. Thank you very much.